Hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B. Today we're going to be talking about accounting for corporations, which includes things like stocks, bonds, and other methods to raise funds, right, for a corporation, which is primarily through the sale of stocks and bonds and a couple of other equity methods. So we'll be doing a deeper dive in the equity part of the accounting equation. So before we jump into that, I would like to remind you all that we are currently beginning week 7. Week 7. This is an 8-week course, as you know. So what does that mean for us? By now, we are now we're in module 4 now, which is the last module of the course. We're in week 7. Week 7, today we're going to cover chapters 13 and 14. There is a homework assignment for 13, a quiz for 14. As a friendly reminder, all quizzes and all homework assignments, you can take those up to 2 times. I've said that multiple times throughout the past 7 weeks, and I'm just going to remind you once more. Again, you can take the homework assignments and the quizzes up to 2 times in order to earn a higher grade. The higher of the 2 grade will be accepted into the grade book. So please make sure you're doing that. If you're not doing that, you're leaving points on the table. Okay, so it's really, really important that you do that. You can even go back in time. Okay, so you can go back to the past 7 weeks and retake them if you haven't already. Right? It's really important that you do that in order to or try to earn the highest grade possible. As I had said multiple times in this course, the only way you learn accounting is by doing it. You can read the chapter, reread the chapter, rewatch the videos, read the PowerPoints. All that's good, right? It's important that you do all those things. You really have to in order to understand, in order to pass this course. But in addition to that, you also need to be trying the homework and quiz twice. The only way you learn accounting is by doing it. Okay, so that's why it's really, really important that in addition to reading, in addition to the PowerPoints, in addition to the attending the lectures, you really do need to do it. And the only way to do it is by doing the homework assignments and quizzes twice. Okay. That's in accounting we learn by doing. That's the only way you'll learn it. Otherwise, you're just not going to get it. Okay. So, very important. That's if you plan on retaking any homework assignments, any quizzes, anything like that, all of that needs to be done before you take the final exam next week. Okay. I cannot accept anything past October 17th. October 17th is the last day of this course. It is the last day to do anything in this course. At that point, it will be locked down and the final grades will be submitted to the university. So, having said all of that, I want you to be very focused on this course over the next 10 days. Why is that? You got 12 days left in the course. 12 days, okay? You got 12 days to complete chapter 13, 14, and 15, 16 next week. 12 days. My recommendation, start working ahead. You want to make sure you give yourself enough time to focus on that final exam. The final exam can only be taken once. The final exam can only be taken one time. There are 20 questions on the final exam. The final exam covers everything that happened since the midterm. So what does that mean? It covers weeks 5 through 8. Weeks 5 through 8 are covered on the final exam. There are 20 questions. And I could already hear you, Dr. B. Let me do some quick math here. Well, if it's weeks 5 through 8, week 5 was chapter 9, and this covers up to chapter 16. That's about one question, 1.2 questions per chapter. Okay, so what does that mean? There's 20 questions. Some questions will have two questions from that chapter. Well, here's a little hint for you. Chapters 16, 15, 14, 13. Guess what? There's 2 questions from those chapters. The rest of it's just 1 question from those other chapters, okay? Good news. Only 5 questions are math driven. Only 5 questions on the final exam are math driven. The rest of them, it's all about the definitions. Okay, it's all about the terms. It's all about understanding the terms. So, it's open book. It's open note. It's open everything. If you can't pass that, I'll be very concerned. Okay? It's open book. It's open note. It's not timed. Okay? You can save it. You can go back to it. It's open right now. In fact, one of you already took it and did pretty well. So I just want you to understand that. It's ready. Any questions so far? You all right? All right. Cool. Let's go ahead and jump into it. We are in week 7 out of 8-week course. We're in chapter 13, which is on corporate accounting, accounting for corporations, whatever you want to call it. It's the same thing. Corporate accounting. The concept behind accounting for corporations is corporations, these are C Corp, S Corp, they raise capital. Capital meaning cash. They raise capital by selling stock in the company. Stock is a form of ownership in the company. Most of you hold stock, even if you don't know that you do. If you have a 401k, a retirement savings account, there's a good chance, almost like a 99% chance, that you have stock in a couple of different companies, or several, or a lot, or you have a what we call a mutual. A mutual is a lot of different stocks, or if you have a group, there's a lot of different stocks in those groups. Like for example, if there's a lot of retirement funds with just a year that you're going to retire on it, there's a ton of different stocks in those. So take a look. If you have a 401k or any type of retirement account, take a look at it. You take a look at the different stocks that are in there. Those you own that company. You're part owner. Why is that? Well, you own a share of that stock, and it's important to understand that because a lot of individuals they don't quite grasp the gravity of owning a company. When you own a share of stock, you own the rights to that share. And what that means is you can buy and sell those shares. Now, it's a little bit different in a retirement account because, a lot of times it's governed by a company, someone else, right? By the company, by a retirement benefit plan administrator. And so you can't exactly change out different shares within those plans, but you can always change your plan, right? And so that's why it's important to kind of understand that concept. So let's go ahead and dive into corporations, the different types of corporations. Really, there's 2 types of companies. There's private and there's public. For a company to be private, it means that it's not, they do not sell shares of stock on the open exchanges. An open exchange is like the New York Stock Exchange, the Chicago Exchange, the NASDAQ, the S&P 500. There's so many different ones, right? If it's private, they do not sell on the open exchanges. I cannot go buy a share of a company that's private, okay, because they do not openly sell their shares of stock to the public. That's why they call them public exchanges, right? Publicly held companies, they sell their shares of stock on the open exchanges. So if you go to the Nasdaq or the New York Stock Exchange or to the Chicago Exchange or to wherever, and you're interested in buying shares of stock, you can do that because the stock is what we call publicly held. It's owned by the public through shares of stock. A couple of examples. Private company. Let me think. Any do any of you know of a company that does not sell shares of stock? Any examples? Private company. Anyone at all? Come on, I know you guys know. Marina.
No, I don't.
You don't? Come on. Okay.
No.
What about let's say Panera Bread? Do they sell shares of stock? I don't know if they do. I don't think they do.
Yes, they do.
They do. Okay.
They do.
All right. Bad example. Who else? Anyone know?
Wait, are you asking for publicly held or privately held
Private.
ownership?
Private.
Private? Oh, no.
Okay. Yeah, I don't know. Okay, let's say you own a catering business. It's probably a private business, right? Those small businesses, those are private. They don't sell shares of stock on the exchange. So if I go down the street to the local ice cream shop, there's a good chance they're not selling shares of stock on the New York Stock Exchange. It's a small local company. So small local companies are example of privately held companies. They do not sell shares of stock.
Fidelity?
Sorry, go ahead.
It's saying Fidelity, Bloomberg, like the
So
newspaper.
most of those are actually publicly traded companies. They sell shares of stock. So Bloomberg, they have their own company is public. Fidelity, their own company is public, so they sell shares of stock. So those would be great examples of publicly held companies.
Okay, well, I say that because I
Dr. B?
actually looked it up, and it's saying that it's private.
Well, I'm pretty sure they're pretty positive they're public.
Hold on. If it's public, they should have a ticker, right? Like
Yep, absolutely, and they do. I know that Fidelity does for 100% positive. Go ahead.
I was gonna say Heavy Seas Brewery. It's in Maryland.
Yeah,
It's
I know
privately
Heavy
owned.
Seas. Yep. Mm-hmm. Yep.
And another one would be like Nothing But Cake. They sell little cupcakes, and there's like 5 stores in the DC, Maryland area. I think those are 2 examples.
Those are great examples. Yes, absolutely. Is that Nassim? It sounds like Nassim's voice.
Yes.
Okay.
I'm on the phone right now because I'm driving.
Oh, that's okay. No worries. Thank you, Nassim. Yeah, excellent examples. So Nothing But Cake. That'll be a private business. Chick-fil-A. Ooh, good question, Tylexis. I think they are private, if I'm not mistaken. I don't recall seeing a ticker symbol for Chick-fil-A.
Yeah, there isn't one.
Yeah, I think you're right, Tylexis. I think Chick-fil-A is a private company. Yeah, well, very well done. Very cool. Gyms, yeah. So like Gold's Gym, I think they used to be.
I think IKEA too.
IKEA, that's a good question. I don't remember. IKEA might be private again. I think they were public before. And that happens from time to time too. Like a company will be public and then go private. An example of that is Sears.
They're private.
They are private. Okay, good to know.
IKEA is private, yes.
Yep, awesome. An example would be Sears. They used to be public. Now they're private. Okay, so they were taken off of the stock exchange because they were bought by a group of individual investors, and they're taken private. So that
Didn't Sears go out?
I think Aldi's too. Aldi.
Aldi, yep, that happened to Aldi as well. Mm-hmm.
Didn't Sears go out of business?
Nope, they're still in business. They have I
Wow.
think like 100 stores throughout the United States, and they have their website still operating, and they still have a couple of stores. Even in the DC area, I think they have 3 stores left.
I
Um,
would say
Wow.
the season.
yep,
Yes.
yep. So they're still in business, but they're taken private, so that's why they're no longer on the stock exchange. And that happens. So it's important to understand how those businesses are. Whether it's public or private. Um, Not as popular. Well, yeah, that's an understatement, my friend. um, yeah, there's a lot of reasons why that happened. So let's take a better understanding of the characteristics of publicly traded companies. They're typically separate legal entities, meaning they pay their own taxes. The corporation pays the taxes on behalf of the corporation. The individual owners do not. They pay their their individual taxes, right? Uh, Corporations they have limited liability. There's transfership of ownership rights, meaning individual owners can transfer their rights to other owners by selling their shares of stock. There's continuous life. So if a public corporation will continue to live forward even after the original owners pass away. Classic examples: Ford. Ford went public back in the 1930s. Okay, Ford. Obviously, the original owner's been dead for like 50 years, right? But the company still lives on, so that's continuous life. There's no mutual agency for stockholders, and there is it's easy to raise capital and the reason why it's easy to raise capital for publicly traded companies is they sell shares of stock created by the company, so it's very easy to raise capital. So a couple of disadvantages of these publicly traded companies is there's a lot of government regulation, a lot of red tape. There's a lot of rules that they have to follow, and which makes it slower to do things, and it makes it, there's hurdles, right? With anytime there's government intervention, it usually makes it more difficult to do things. It's less flexibility, if you will, and then corporate taxation. Right now in the United States, we were fortunate in 2017 when the tax rate was cut. Corporations used to pay anywhere between 28 to 32% in taxes. Now they pay about 21% in taxes. So that was a good thing that happened. It'll be interesting to see what Congress does in the near future if they decide to raise the corporate tax rates again. If it were me, I certainly would not do that now because we're still recovering from the pandemic in the economy. So raising taxes during a recovery is usually not a wise decision. Let's take a look at this is a really important organizational chart to understand. Publicly traded companies are run by the stockholders. Publicly traded companies are run by the stockholders, not by anyone else. Okay. What do we mean by that? Publicly traded companies, the stockholders vote. They vote for the board of directors. They elect the board of directors for the company. Okay. The stockholders elect the board of directors. What does that mean? Individual stockholders have rights. They have rights that they're called voting rights. And their voting rights, they have the right to vote on who runs the company. So ultimately, the stockholders have control over the publicly traded companies. They elect the board of directors. The board of directors then hires the president, vice president, other operating officers of the company. And then those individuals hire the employees that work at the company. So it's important to understand this concept because publicly traded companies are dictated by the stockholders. The stockholders are at the top of the organization because they elect the board of directors.
Professor,
Yes, please, Mark.
so you're saying the stockholders hold the majority of what the company. So let me understand this correctly.
Sure.
So the stockholders, they make the decisions and it passes down from the board of directors to the president, to the vice president, and the other officers, correct?
So not quite. They don't exactly make this. The stockholders don't make decisions for the company. The only thing the stockholders do is they vote on who is on the board of directors. So they're selecting the board of directors. The board of directors ultimately make the decisions. Does that help clarify?
So the board of directors basically hires your president, vice president, and the middle management.
Yes, the CEO,
Okay.
CFO, CIO.
Okay.
Yeah.
That makes sense.
So the reason why the stockholders are at the top is because they're the ones that are voting on the board of directors. And so they elect the board of directors, and then the board of directors ultimately make the operating decisions.
Okay. So if, let's say, for instance, if hypothetically question,
Sure.
if a fraud came through the company,
Mhm.
the board of directors make that decision to fire or eliminate
Yes.
somebody?
Yes.
Hmm.
Yeah, the board of directors ultimately is responsible for firing and hiring like the CEO, CFO, CIO, et cetera.
So that's what happened to Enron.
Yes, that is what happened to Enron. That's right. Yeah. Yeah, good story. I remember.
Enron was crazy. I had a question though.
Yeah, Tyler, go ahead.
Because this is coming from my business course from last semester. It says that owners of common stock, I don't know if it's the same thing, because I know there's common stock and
And
whatchamacallit?
preferred stock. Yep.
Preferred stock, yeah.
Mhm.
So it says owners of common. I'm literally about to say the slide that you're on right now.
Hey, it's all right. Yeah. So excellent point. So just as Tyler was about to say, there are two types of stock. There's preferred stock and there's common stock. Preferred stock is in the word preferred. Preferred simply means that these are the individuals that are the board of directors. They are the employees of the company. They typically own shares of stock in the corporation called preferred stock. Preferred stock does not have voting rights. They can't vote on themselves. Okay? The preferred stock is really part of the package when they were hired, right? It's like a benefit package. You get shares of stock in the company. That's a common benefit package. Preferred stock represents those shares of stock in the company that are held by the individuals working for the company and the board of directors. An example of that, we have a CEO. The CEO has 20,000 shares of stock of their own company. Those 20,000 shares are preferred stock. The preferred stock has a value attached to the shares of stock that is typically dictated off of the market, right? The market price of the shares of stock change every minute of every second of every day. And so they have the right to buy and sell shares of preferred stock. Those are for individuals working with the company. Common stock is the other type of stock. Common stock is held by the common public. So I have a lot of shares of common stock. I have Starbucks. I have a lot of other companies that I like, that I invest in, that I purchase their shares of stock. And my shares of stock are called common stock. The reason why it's called common stock is because anyone can purchase it on the open exchange. So it makes it common. With common stock, I have the right to vote in stockholders' meetings. or I can select a proxy for voting. I have the right to sell my stock. I have the right to purchase more shares of common stock. I have the right to receive dividends, assuming that the board of directors elects to have a dividend, or they have to vote to have a dividend. And just so you know, a dividend, Mark, is it's what's paid. It's like a I don't want to say interest, but it's like a
So
it's like a
basically, it's money coming to you, correct?
yeah. So the
Okay.
board of directors will say, hey, we're going to elect to give a dividend to all of our stockholders, and it's usually like 50 cents, a dollar, a couple dollars for every share of stock that I own. And basically, it's like saying thanks for owning our stock. We did really well this year. You know, we made a lot of profit. So we're gonna give some of that profit to our stockholders as a thank you, or as a nice benefit to owning the shares of stock. That's what.
Okay, I have a question.
Go ahead, Mark.
So I've been watching this TV show. It's no longer, well, it was on USA. It's called Suits. It was, so let's say for instance, this person owns a percentage in a law firm.
Okay, sure.
So does the stockholder make all the decisions based on the law firm?
Yeah, good questions. It depends
Okay,
on the
so
it depends on the type of stock it is. If it's preferred stock, they don't have any of these rights.
because the main reason why I was asking was because the show kept reminding me of some of the stuff that you went over in previous chapters.
Mm-hmm.
So they kept talking about shares, buying, not proxies, but what do you call them?
Preferred stock.
Contracts or something like that.
Uh-huh.
So in one of your previous chapters, I had to go back over and reread it because the simple fact of the matter is it was on one of your slides where you were talking about how the accounting process and how uh, what is the word I'm looking for? It'll come to me later, but I just wanted to let you know. So it's basically you're buying something and you're getting money for it.
Oh yeah. You're talking about paid in capital, and you're receiving. So like an investor comes in, they buy a part of the business, they put in capital, right? It's which is a part of their equity, and they're putting cash in. They receive part ownership of the business, and so it's usually like a percentage that they have of the business. And so with that percentage, and I think you're talking about the partnership accounting chapter, if I'm not mistaken, and it represents the percentage of that they own in the business, and that they also are liable for any loss, but they also get a percentage of that profit based off their percentage of ownership. And that's very common, Mark, when it comes to partnerships, which is different than a corporation, but partnership is similar in that nature. So it's not exactly shares of stock, but it's a percentage ownership of the business. A little bit different. Yeah, good discussion. The other thing that common stock holders have is a shared of assets of remaining after creditors paid in a liquidation. What that last one means is when a company goes out of business, let's say it's Sears, okay? Perfect example. Let's say Sears goes out of business, or they declare bankruptcy, okay? Which they did. Company declares bankruptcy. I'm a shareholder in the company. When the company declares bankruptcy, after the creditors get paid in a liquidation, Chapter 7, After the creditors get paid, the creditors meaning the banks that lent them money, then I, the shareholder, have rights to any of the remaining assets. So I can say, hey, I have this percentage of the company through my shares. You need to pay me whatever's left. And oftentimes it's zero, just so you know. But it's in real life, it's usually nothing. So here's a share of stock. This is what it looks like. It is quite literally a share. Why do they call it stock? Because before the digital age, we used to print everything on stock paper. It's a literal stock, so that's how it got its name, right? It's a piece of paper. It's on stock paper, and it's a share of ownership. That is what stock certificate is. It represents that share of ownership, and this stock certificate is proof that I am a stockholder of this company. Here's my certificate of the ownership. Each certificate has a serial number printed on it. It's unique to that share of stock, and it represents that share of ownership. And this is true. So if you go and buy a share of whatever stock, nowadays it's digital. They'll send you a receipt, but they used to send a physical share of stock, and it looks just like this. It has a serial number on it. It's got signatures. It says exactly what it is. It's kind of cool, right? So when a share of stock is sold, the stockholder signs a transfer endorsement on the back of the certificate, just like you would sign over a check to someone, right? You sign the back of it. Same concept applied, but nowadays it's all digital. So it'd be a digital signature. So when a company is formed, the board of directors and the charter of the company dictates the number of shares that the company plans to sell. And it's a total number, right? It'll say, okay, how do they come up with a number is a good question too, because let's get a little money, but oftentimes what happens is the number of shares that the company decides to sell or authorize is based off of an arbitrary number. They'll say, hey, we plan to raise so much money, and if we sell it at $1 a piece, then we'll say let's authorize 250 million shares because we want to raise $250 million. And that's typically how they figure out how many shares they're going to originally authorize. So when a company is formed, company's brand new, publicly traded company, they decide how many shares to authorize, how many shares they're going to sell to the public. And so they'll do this. So that's what when you hear the word authorized, it means how many shares the company plans to sell to the public when they're first formed. So authorized, that's the total number of shares, of shares the company plans to issue or authorize. A couple of key items here. When it's common stock or preferred stock, we attach this thing called a par value. Par value is an arbitrary amount. It's an arbitrary amount that a company uses to designate or apply a value to each share of stock as it's being authorized. So essentially, that's how we attribute value to the stock when it's first created, is through par value. We'll talk about that here in a little bit. The company authorizes, meaning this is the number of shares that are in this company, period. That's the total amount. When a share is issued, it is when we are selling the share to the public, issued. It's issued, it's sold. And if a share is outstanding, it means that, so authorized is when the company says this is the number of shares our company has. When it's issued, it means this is the number of stock that we sold to the public. When it's outstanding, that's the number of shares that the public owns. Outstanding is the number of shares the public owns. It's outstanding. It's outside of the business. Outstanding. We'll talk in deep about each of those. So par value. Par value is an arbitrary number assigned to the stock when it's authorized. That's how we give value to a share of stock when it's first created. That is not the same as market price. Par value is not the same as market price. Par value is not the same as market price. A lot of people think that it is. That's why it gets confusing. Par value is simply an arbitrary number that we apply when it's authorized. It's usually very low. It's like a penny, 2 pennies, 5 cents, maybe $1. Market price is what a share is worth when it's on the open market. That's what it means, market price. When something's market price, that's the price that you're buying it at that time, on that day, right? On the open exchange, market price. There are 3 classes of stock. So we talked about common stock, preferred stock. We're talking about the individual stocks now. So a share of common stock or a share of preferred stock has these things. It has one of these 3 things. Par value, which is an arbitrary amount assigned to it at the time it's authorized. A non-par value, or a stated value. The non-par value is essentially a value that is assigned to the share of stock, and it's based off of who owns it. Typically, non-par value is assigned to the board of directors. Stated value is simply that. It says, hey, this is the value of this share of stock, period. It's usually not correlated with market price. Think of the balance sheet. On the balance sheet, as you know, you have assets, liabilities, and equity. Your assets are your cash, your accounts receivable, your inventory, property, plant, and equipment, etc. Accounts receivable. On your liabilities, you have accounts payable, wages payable, notes payable, etc. Anything that's owed. Your equity represents ownership, right? The ownership of the business. What the owners own, as we said many weeks ago. What the owners own. We have paid-in capital, retained earnings, and then your stock, right? Your paid-in capital, and remember, Mark, you and I just talked about this. So the owner comes, a new investor comes to the company, and they pay in to the company. They're buying in. They're purchasing a percentage of ownership. So when that happens is we debit cash to increase cash, and we credit paid-in capital for that individual person who's buying shares of ownership of the company. In this exchange, it's basically stock, right? It's basically stock because the stockholder is purchasing stock. They're buying into the company. So it goes into our paid-in capital account. My pleasure. Absolutely. Anytime. Retained earnings. Retained earnings is what is retained in the business. I'm sure you all remember when we talked about that. When something's retained, it means it's left in the business. This is after our net income has been distributed. So on our income statement, we have revenue minus expenses equals net income. Well, you know that it's a little bit more than that. It's revenue minus cost of goods sold equals gross profit minus expenses equals net income. The net income is essentially the profit after all of the expenses have been paid out. Sometimes it's a loss. It could be a net loss if it's a minus amount. That means your expenses were higher than your revenue. If it's net income, it becomes retained earnings. We leave that profit in the business in order to invest in the business, to grow the business. That is retained earnings. There's another financial statement. It's called the Statement of Retained Earnings. It's the fourth financial statement. We have the income statement, balance sheet, statement of cash flows, and the retained earnings. Statement of Retained Earnings. The Statement of Retained Earnings has this thing called dividends that we talked about. Those are payments made to the stockholders. So it's net income minus, well, it's retained earnings plus net income minus dividends equals ending balance retained earnings. And
Okay, I have a question.
Yeah, go ahead, Tyler.
I maybe I'll understand later, but I'm really having a hard time finding the difference. Well, I know the difference between paid-in capital and retained earnings as it is in the PowerPoint, but like, how does money that someone pays or buys into a stock not transfer to net income, which in turn wouldn't become retained earnings?
Sure, I got you. Okay, think of it this way, Tyler. So I invest in a company. I'm giving them cash, and they're giving me shares of
Okay.
stock. Okay,
Mm-hmm.
that's a straight cash investment into the business, right?
Yes.
Net income derives from sales. Because I gave them cash, that's not a sale. They didn't sell me something. They didn't sell me a product. They didn't sell me a service. All I did is I gave them cash in exchange for ownership in the business, which is stock.
Well, yeah, that's so I guess maybe it's thought of differently because the way I was thinking of it is like technically aren't you selling ownership?
No,
Okay.
no, because the cash is not revenue. That's where the disconnect is. Cash is not revenue.
Oh,
Cash
true.
is just
Yep.
cash.
Yeah.
Revenue comes from selling goods and services.
Okay.
So cash is not the same as your revenue. That's totally different.
Okay.
Cash is just cash. It's an investment into the business.
Oh,
It's
so
an
this is
asset.
like an income statement balance sheet
You got
difference.
it. You got it.
Okay.
So cash is on your balance sheet and stock
Pass through
is on your
stock.
balance sheet, right? Cash is an asset. Stock is equity. When I invest in a business,
Yes.
I'm increasing my assets and I'm increasing my equity.
So paid in capital is a equity account.
That's correct. Yep, paid-in capital
Okay.
is an equity account. Absolutely.
Okay. All right. So I think I just need you to explain retained earnings again or more, whatever you're going to do
Yeah,
here,
my
please.
pleasure. So on our income statement,
Mm-hmm.
we have this thing called net income. And net income comes from sales, which is revenue,
Mm-hmm.
minus cost of goods sold equals gross profit minus expenses equals net income. Net income is always at the bottom of your income statement.
Mm-hmm.
At the end of the accounting cycle, we close our books. We zero out our income statement to get it back to zero for the next accounting period.
Mm-hmm.
And when we do that, we're transferring our net income to this account called retained earnings. And we do that by debiting our net income and we actually debit our sales account and we credit retained earnings. We debit our retained earnings, credit our expenses to get it down to zero. By
Mhm.
doing that, we're transferring net income, which is sales minus expenses, to
Is there an
retained
income
earnings.
summary involved, or is it always
Yeah,
involved?
that's what that
What
is.
part
It's a
is it?
sales summary, exactly. That's
Okay.
exactly what that is. That's what retained earnings essentially is. It's what's
Okay.
left from your sales summary.
Okay.
Yeah. And so retained earnings is what's left in the business because that's a permanent account. We have to close our temporary accounts, which is our revenue and expenses, to a permanent account in order to zero out temporary accounts.
Right.
And we do that by transferring our sales summary to retained earnings. And retained earnings is a permanent account, and it's actually a part of equity, but it's also its own financial statement. And retained earnings is what's left in the business. That's why it's called retained. It's kept in the
Mhm.
business. And then out of retained earnings, we pay out any dividends to our stockholders. So retained earnings minus dividends equals ending balance retained earnings, which shows up on our balance sheet under equity.
Okay, so when it says retained earnings is cumulative net income or loss not distributed as dividends, it's that amount before the dividends get taken out?
Correct. Correct. It's the
Oh.
amount before the dividends. You got it.
S- So so where are we accounting for dividends being taken out? Is that going to be on the statement of retained earnings?
Yes. Yes, it is. And then so you have beginning balance retained earnings minus dividends equals ending balance retained earnings, essentially. Yeah.
Okay. Beginning
Well,
balance retained.
well,
Okay.
technically, it's net income minus dividends equals ending balance retained earnings. It can be
Okay.
displayed either way. Yeah. Excellent question. Very good. Let's take a little deeper look at stock. When we issue par value stock at par, we are, it sounds funny, right? Remember, par value is an arbitrary amount that we assign to each share of stock as the company is formed. Basically, it gives value to each share of stock at the formation of the company. When we issue par value, we're making it available for sale. We're saying, hey, these are the amount of stock that is available for sale to the public, and we assign it a value of par value. When you see the word at par value stock at par, it means we're selling it for par value, whatever we determine par value is. So we have a transaction. This is a journal entry. On June 5th, our company sells snowboards, by the way. On June 5th, we issued 30,000 shares of $10 par value stock for 300,000. How do we get 300,000? 30,000 times 10 is 300,000. So let's record the transaction. When we issued it, it means we sold it to the public. Yeah. So we debit cash 300,000. Why do we debit cash at 300,000? Got cash coming into the business from the sale of common stock at par value. So debit cash 300,000. We credit common stock 300,000. Cash is an asset account. Common stock is an equity account. We increased our asset. We increased our equity. The accounting equation is still in balance. Remember, the accounting equation is assets equals liabilities plus equity. We didn't touch liabilities. There is no liability here. We increased
I have a
our
question.
asset, which is cash. We increased our common stock, which is equity. Go ahead, Tyler.
Common stock, is that the same as paid in capital? Or what's the difference between the two? As in this.
Yeah, great question. So paid in capital is when there's a simple investment made by a partner of the business. I go to a company and I say, hey, here's $1 million. So they'll debit cash $1 million, they'll credit paid in capital $1 million. But if I'm
So
selling stock to the public, we just call it common stock.
So in the first example, it's just an investment into the business.
Correct.
Ownership isn't involved.
And that's right. Well, there's ownership involved, but it's in the form of paid in capital, not in the form of common stock.
Okay, I guess. Oh, wait, no, you already said common stock is the public and paid in capital is what, a member of the business, right?
You got it. Yep.
Okay, okay,
Cool.
okay. That makes
Yep.
sense.
They're two different accounts. Yep.
Okay.
For two different purposes. Very good question. Yeah, absolutely. I'm going to talk about premium and discount. When we sell common stock, we could sell it above par value or below par value. The reason why we would sell something above par value is, of course, to get additional capital, additional cash, right? So if I sell something above par value, above the stated value of the stock, the objective here is to earn additional cash, right? That's why we do something like that. When it's above par value, it means we're selling the shares of stock at a premium. The word premium basically means above value. That's what a premium is, right? We all pay premiums at some point in our lives on various things, right? We pay above market price for whatever reason. Maybe, like, let's say it's an eBay thing, right? You're bidding on it. Oh, here's the market value, and the price goes up, 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 up. You're putting a premium. Let's say you really want that PS5, but you can't get a hold of it because no one freaking can. All right, so PS5 comes out. They price it at $300. Right now, they're selling for like $1,000. Why is that? Why did it go above the 300 market price to a premium of $1,000? Why did it happen? Because there's not enough of it available in the marketplace. So that's why the price is so high on something like eBay or whatever. So the same concept applies with stock. If a lot of people want my stock, I'll sell it at a premium. I'll sell it above my par value in order to gain additional cash from the higher demand. And so, in this example, a lot of people want my stock. I issued 30,000 shares. It's worth $10 a share. I'm going to sell for $12 a share. Because remember, a lot of people want it. So to record this transaction, we debit cash, $360,000. How do we get that amount, you might be asking? 30,000 shares times $12 per share. So 30,000 times 12, 360,000. Debit cash, 360,000, increase our cash. We credit common stock, 300,000. I already hear you, Dr. B. Why is there a difference? The par value of each share of stock is $10. So I need to account for the par value of each share of stock. How do I do that? I take the 30,000 shares of stock I issued at its par times its par value. In this case, $10. So that's how I got 300,000. So I debit cash 360,000. I credit common stock 300,000 because that's the total value of the stock, right? $10 per share par value times the number of shares issued. And then I credit another account called paid in capital in excess of par value common stock. It's a long name for an account, but yes, that's the name of the account. We credit paid in capital in excess of par value common stock. 60,000, which is the difference, obviously. And it's in excess of par value because it's above par value. It's at a premium. If it's above par value, it's called a premium. If it's below, it's called a discount.
Okay.
Tyler.
So there's paid in capital and common stock in this last account. So can you understand like what it's exactly like? I get the this is the amount above the initial par value. But why is the paid in capital in there if it's the common people that are paying for it?
I want you to think of paid in capital as the general ledger account.
Okay.
So paid in capital is a general ledger account. As you hopefully remember, general ledger account is like the parent account.
Mhm.
Okay. And then you have these things called subsidiary accounts.
Mm-hmm.
The subsidiary accounts are like the children of the parent, right?
Right.
And there are a lot of paid in capital subsidiary accounts.
Okay.
One of those being common stock, another one be preferred stock, another one would be um, other types of equity. But they're all forms of paid in capital. The word paid in capital means the investment into the business. And so that's why you see paid in capital showing up here.
Okay.
Does
It's
that
like
help?
a parent category. Okay.
Yeah, exactly. It's a general ledger account. Yep.
Okay.
Excellent question. So when we issue par value, and this basically just kind of summarizes the transactions, right? So we, in this example, we issue common stock, 50,000 shares at $10 par value. We've authorized. Now here's where the words come in, and it's real important to understand the definitions, right? So remember, par value, arbitrary amount assigned to each share of stock as it's being authorized. The word authorized means that's the total number of shares for that company. Issued is the shares that we sold. Outstanding are the number of shares outside of the company. Very important that you remember those terms because it gets confusing if you don't know those terms. Yeah.
Wait, so the
Sure.
50,000 shares authorized, that's
Yep.
like how much we have available, right? And then the 30,000 is how much we actually sold.
You got it.
Okay,
Yep.
thank you.
You're very welcome. Yeah, that's 100%
Wait,
right.
so
Tyler.
30,000 sold is under the blanket term issued and outstanding, or it's just issued?
It's issued. Well, in this example, it's issued and outstanding. So sometimes there might already be some outstanding. The word outstanding means it's outside of the company. It's already in the hands of shareholders.
Okay.
So
So
we
yeah, it's like
we would
it's like-
issue shares of stock as it's being sold. Yeah.
yes. Okay.
Cool. Excellent question. So we authorized 50,000 shares. We sold 30,000 shares. So what's the amount? It's 300,000. Why? $10 per par value, the value of each share, times the number of shares I actually sold. 30,000. 10 times 30,000, 300,000. Then I have the paid in capital in excess of par, 60,000. Because I sold $12 per share or whatever. So 60,000. Then I have beginning balance retained earnings 65,000 equals my total shareholders equity 425,000. On your balance sheet, if you look at your balance sheet under equity, you have your paid in capital accounts, you have your common stock, preferred stock, retained earnings, etc. You add up all of those things to get to your total stockholders equity. So this kind of shows you where that information would be shown, right? On your balance sheet. What if there's no par value? When there's no par value, or not what we call, it's actually non-par value. No par value, non-par value is really the same. No par value simply means we did not assign an arbitrary amount to each share of stock. So typically what happens here is we use the market value at that time. When there's no par value, we substitute it for the market value. Remember, the market value is how much it's worth on the open exchange at that time. So here's an example. We sold 1,000 shares at $40 per share. Debit cash, 40,000. Credit common stock, no par value, 40,000. It's important that it says no par value or par value or whatever, so that way in the notes we understand which kind of common stock was it. That's why we have this. Here's stated value. Stated value. Oh, this looks like a premium, right? So on June 5th, we sold 1,000 shares of $40 stated value stock for $50 a share. In other words, I sold it for $10 premium on each share, is what that tells me. How do I know that? I sold it for $50 a share, which is above the stated value. It's above, it's at a premium, which means it's in excess. So I debit cash, 50,000, 1,000 times 50. I credit common stock, stated value, $40,000. Why is it not 50? Because remember, it's the stated value. How much the stock actually worth? $40,000. 40 times 1,000. And I credit paid in capital in excess of stated value. Common stock, 10,000. That's the difference. I sold it for the premium. For the premium.
Okay, wait, I have a question about
Are you-
that. So anytime we or I guess we always have to put how much we would have made if we sold it at the original price, is what you're saying?
Yes. Yep. So when you record your common stock or preferred stock, it needs to be recorded at its value. So and then it would be in excess or under, depending on if it was in excess or under.
Okay.
Right. So basically, it's kind of like how you would show profit, right? It's like we received this much cash. It was actually worth this much, and this is how much additional or less we got.
Oh, okay. Cool.
Make sense?
Yeah.
Cool. So yeah, the short answer is yes. We would always record what the actual value is. Good question. Okay, this part gets a little confusing, but it's a good concept to understand. Issuing stock for non-cash assets. Okay. So think back when we first formed a business. The owners of the business bring in various assets. I might bring in some property, plant, equipment, other assets to get the business up and running other than cash. I might, like, let's say I have a bakery and I start my bakery business with my own mixer, my own KitchenAid mixer I have at my house. So I bring that into my bakery business. So, of course, there's a value associated with that mixer. So I would receive shares of stock or some type of exchange for that asset that I brought into the business. So in this example, we're bringing land into the business in exchange for shares of stock. So there's no cash, of course, but we're still using assets. So in this example, I'm bringing in land that's valued at $105,000, and I'm going to receive 4,000 shares of stock, of some type of stock, $20 per par value. Okay. So I debit land. Land is the asset I would debit. So debit land to increase land, $105,000 worth. I credit common stock par value, $80,000. Because remember, I need to account for the actual value of the stock. So $20 per share times 4,000, that's $80,000. And then I credit paid in capital in excess of par value, 25,000. Because remember, it's above the par value. It's basically the same as it's similar to the cash example, except this is land instead of cash. That's what non-cash assets mean. I'm exchanging, right? It's an exchange. Here's some land for shares of ownership. Here's some machinery for shares of ownership, etc. Organizing work. I don't even know what the hell that is. Okay, so here's another example. I got somebody who helped me out when I started up my business, and instead of paying them in cash, I'm going to give them shares of stock. That's a nice exchange because we hope that the stock goes up. So on June 5th, I gave 600 shares at $15 per share for work valued at $12,000. So a debit organization expense, $12,000. This person helped me to organize the business. In other words, they helped me to write the charter and et cetera, et cetera. But instead of paying them in cash, I'm going to give them shares of stock in the company. So I debit the expense, organization expense, $12,000. The expense, as you know, is an income on your income statement. It's an expense, $12,000. Now I'm going to credit common stock, $15 par value. 600 shares times $15 per share. What is that? 9,000, right? Yep, 9,000. And I'm going to credit paid in capital, in excess, 3,000.
I have a question about that.
Dario, go for it.
Yeah, how can you pay someone with stocks since technically it isn't like promised money, like if you were to pay them like with a paycheck or something like that?
Yeah, good question.
Because that's kind of a risk, isn't it?
It's a huge risk because if the company goes out of business, that person just got screwed out of 12 grand. Yeah, it's a risk. Some people make agreements that are silly. This is one of them. It's not something I would ever do. I'll tell you that much. If somebody was like, "Oh, hey, I'll give you shares of stock instead of giving you cash," no, that's okay. I'd rather take the cash. But yeah, so sometimes people will make agreements by saying, "Hey, if you do a little work for me now, I'll give you shares of stock in the company." Well, that's all fine and dandy, and some people agree to those types of things, but I personally wouldn't. But this is an example of one of those type of situations, I guess, that where something like that would arise. It's not very common, to be honest. It's a kind of obscure, actually. Out of a lot of companies I've done consulting work with, I've almost never seen this happen. But once in a great while, it does, and that's maybe a bunch of friends got together and they're trying to help their buddy out, trying to get their company up and running. And I might say, hey, you know what? I really don't have the cash to give you, but I'll give you shares of ownership in the company. And so this is when something like that might happen. Good question, Dario. But yeah, it really doesn't happen that frequently. Okay, let's take a deeper look at dividends. Dividends, I love dividends. I do. I mean, I like getting them. I don't like paying them. I like getting them. A dividend is a share of a return on the owner's investment, if you will. It's nice to get them when you get them. They're usually very small, but it's a great way to affect the stock price. What do I mean by that? Not all companies pay dividends. They just don't. Okay. General Electric. I used to have shares of General Electric. For a couple of years, they didn't pay out any dividends. They just decided not to. The board of directors decided not to vote to issue shares. Okay, that happens, right? Some companies do pay dividends. For the ones that do pay dividends, they attract more investors. People want to get a reward for their investment. That's what a dividend really is. It's a reward for the investment. And so people are attracted to rewards. And so the stock price typically goes up when there's dividends being paid out by that company. Why is that? Because more people are attracted to purchase shares of stock in a business that pays out dividends. And so that's kind of that's part of the idea behind paying dividends, because companies don't have to pay dividends. There's no law that says that they have to. Even in their charter, it says that the company board of directors needs to vote on issuing a dividend, and they could decide not to vote on it. The ones that do decide to issue dividends, they attract new investors, and typically their share price is a little bit higher because it's more attractive. It's a more attractive investment. Okay, so go ahead.
Professor, I have a question.
Yes, please.
Is dividends not the same as profits, or is there a difference between the two?
It's different, yeah. So dividends are not profits. A dividend is a payment that the company elects to make to reward their investors. It's not frequent. They're typically done at different dates throughout the year. Some of them don't do it at all. It's just basically an incentive for owning shares of stock, is what a dividend is. It comes from profits. The dividend basically comes from profits. The more profitable a company is, the more likely they are to pay a dividend. But the two are very different. Profit is just it's your net income, right? It's what's left over at the end of the year is your profit. Revenue minus cost of goods sold equals gross profit minus expenses equals net income. Your net income is basically your profit, and that's what you pay your taxes on. But the dividends and profits, they're different. They're not the same. I hope that helps to answer your question.
Yeah, thank you.
You're very welcome. Excellent question. So in order for a company to be able to pay a dividend, there's got to be two things that need to be true. Number one is they have to have a sufficient balance in retained earnings.
Hold on a second.
What? Yes.
I'm sorry.
Oh, that's okay. In order for a company to be able to pay a dividend, they have to have sufficient retained earnings. In other words, they must have made enough profit in order to pay a dividend. Makes sense. And two, they have to have cash to be able to pay the dividend. Makes perfect sense. How else are they going to pay it? Got to have cash. So what happens when a dividend is declared? The board of directors, they get together, they vote to decide to issue a dividend. They record the date of the dividend declaration. In other words, this is the date we voted on declaring a dividend. They record the date of record, and they record the date of the payment to the stockholders. Dates are really important because those three things need to happen in order, right? Board of directors gets together, they vote. That's the date of declaration. And then there's a date of issuance, right? And then there's the date of when it's actually paid. So January 9th, $1 per share dividend is declared for this company. There are 5,000 shares of common stock outstanding. That means that we're going to end up paying out $5,000, right? Because it's $1 per share dividend, 5,000 shares outstanding. So that means we're going to pay $5,000. The dividend will be paid on February 1. The stockholder record is January 22. So what does all this mean, right? The board of directors got together on January 9. They voted January 9 to issue the dividend. So the vote on record is January 22. And then it was actually paid to the stockholders on February 1. So on January 9, is when we got together and voted. I debit retained earnings to decrease my retained earnings. To decrease my retained earnings, $5,000. And I credit common dividend payable, $5,000. Now, this is a new account. You probably haven't seen this one before. Common dividend payable is the account I use to pay dividends to my common stockholders. Common dividend payable, the word payable tells you it is a liability account. Remember, anything that's a payable, that's money that's owed to someone else. Payable is a liability account. So I debit retained earnings to decrease my retained earnings. I credit common dividend payable to increase my liability. On January 22, I simply record the date. There's no journal entry required here because it's just the date saying the board of directors has approved the payment. On February 1st, I'm actually paying my stockholders. So I debit common dividends payable to reduce my liability, and I credit cash to reduce my cash. Make sense? Okay, great. Deficit. I can never pronounce that word right. A deficit. I don't like deficits. That means we don't have enough. That's what a deficit is. I don't have enough. A deficit. Deficit happens when we have a cumulative loss or cumulative losses. I don't like losses. I sure as heck don't like losing money every year. So, what happens? There's not enough to pay a dividend, typically, when there's a deficit. A deficit happens when the company lost money for the year. We call that a loss. So instead of it being net income, it's a net loss, right? And when there's a net loss, that means I need to decrease my retained earnings by that loss. Because whatever I did have left in the business, it's gone because I lost that money, right? I lost that value. So I have an example here. We got 5,000 shares of authorized and outstanding stock at $10 a share, par value. That's $50,000 minus retained earnings deficit. The deficit is how much I lost for that year. I lost $6,000 worth for that year. I had a loss, not a net income, but a net loss. So I subtract that net loss from the par value because the value of each share went down because of the net loss. When a company loses money and they're publicly traded, meaning they had a bad year, real bad year, the value of each share of stock typically goes down. That's why, at the end of every quarter when the earnings statements comes out, if there's a bad year, they always talk about it. So I take my common stock outstanding value, 50,000, minus my loss, 6,000, equals my remaining stockholders' equity, 44,000. So dividends, back to dividends. Dividends, as you know, it's a form of payment. It's a return on the investment, for owning shares of stock. It's nice. We use it to keep market price affordable. What does that mean? Sometimes I don't pay dividends. Sometimes I do, and it depends on what I want my value of my stock price to be. the more dividends I pay out, typically the stock price increases because it's more desirable. If I pay less dividends, I keep it a little less desirable, meaning my stock price a little bit lower. It's a way of influencing the stock price, basically. And it provides evidence that management is and the company is doing well. So when dividends are paid out, it usually means that there's profit involved and the company's doing well. And so it makes a stock more attractive. Sometimes the dividends can be big, sometimes they could be small, sometimes they could be in between. Dividends are considered to be small when there's less than 25% of the previous shares outstanding. So in other words, if I have less shares outstanding, there's oftentimes less distribution, which is less than 25% of all stock outstanding. We call that small stock dividend. A large stock dividend is where we distribute more than 25% of the previous shares outstanding. In other words, more shares of stock outstanding, there's going to be a larger distribution involved. It just kind of tells you about small stock, large stock. It's not all that fascinating, but it's good to know. Here's an example. We have a company that has 10,000 shares, $10 per share stock outstanding. December 31, we declared 10% stock dividend. And the stock price at the time was $15 per share. So here's the formula for it. We have 10,000 shares outstanding. We declare a 10% stock dividend. In other words, I'm going to pay out 10% of my shares. I'm going to pay out 10% of my shares outstanding. So I take the percentage times the number of shares outstanding, gets me to, in this example, $1,000. Or 1,000 shares, sorry. 1,000 shares times $15 per share is $15,000. This is similar to if you hear of a stock split, which we'll talk briefly about. It's basically increasing the number of shares, right, for each shareholder. And in doing that, we don't necessarily change the value of the stock. We simply change the number of shares outstanding. And so basically what that does is it gives each shareholder additional shares. And that's kind of what this represents. So we debit retained earnings, $15,000. Credit common stock distributable, $10,000, which is represented by the par value times the number of shares. And then we have paid in capital in excess of par. In this case, I think it's $5 per share. Don't worry, we don't get too deep in this class. I mean, a lot of that type of stuff is more finance than it is accounting. So we certainly aren't going to get too deep on that. Definitely not on the final exam. Okay. Here's another example. We issued 10,000 shares, $10 per share outstanding, 10% dividend, $15 per share. January 20th, which date was that? That's when we distribute the stock to the stockholders. Debit common stock dividend distributable, credit common stock. December 31, I have, let's see, December 31, we have the declaration. To record the declaration, debit retained earnings, credit common stock dividend distributable. The stock split. Oh, okay. So stocks. When a stock splits, we're increasing the number of shares, but the value stays the same. What does that mean? Let's say you have a share of stock that's worth $20. And the company declares a stock split. So instead of you having one share at $20, you now have two shares at $10 a piece. It's called a stock split. We split the stock in half and create two, right? So why does that happen? This happens because the company is going to have additional shares of stock available. They are issuing additional shares. How do you issue additional shares? Out of your existing shares, you can split them in half to double the amount of shares available. That's why stock splits happen. So there's no change overall when stock splits happens. The only thing that really changes is the number of shares available. That's it. There's really no other impact. So let's talk briefly about preferred stock. We talked a lot about common stock, which is what's commonly available, right? That's why I call it common. Preferred stock is more reserved for individuals within the company, the board of directors, the chief executive officers, etc. Preferred stock is its own class, and it's the shares are based off of dividend distributions, distribution of assets in the case of liquidation. The word preferred means that it's above common. It's above common. They have a dividend rate that's specified, but they don't have voting rights. Preferred stock is basically shares of ownership for the board of directors and employees within the company. The reason why they don't have voting rights is because they should not be able to influence the company. Only the shareholders have the right to influence the company. Preferred stock is can be cumulative or non-cumulative. The word cumulative simply means it accumulates over time, right? Non-cumulative means it's periodic. When it's cumulative, the dividends are what we call in arrears. The word in arrear means it happened already and it accumulated over time, in arrears. And they must be paid before the dividends can be paid to common stockholders. In arrears. Think of it like you work there for a couple of years, they haven't given you the dividend yet, that amount accumulates over time. It's in arrears. They will eventually pay you the dividends. Non-cumulative, it's paid out in future years. So it's periodic. That's really the difference between the two. You don't need to worry about a lot of this other stuff. The dividend preference of preferred stock. So preferred stockholders get paid out before the common stockholders do. That's a very, very common practice in business. Board of directors will declare dividends in each year, and within each year, if it's cumulative, they get paid out the previous years plus the current year. If it's non-cumulative, it's just the current year. Some companies participate or do not participate in the distribution of dividends. And again, the dividends are up to the board of directors to vote whether to even issue dividends in the first place. If they do participate in dividends during that year, dividends they can exceed the stated amount of the common shareholders, and a dividend to the preferred at the preferred rate. So in other words, all the stockholders receive at the preferred rate. And non-participating, so if they don't participate in certain years, dividends are limited to a maximum amount each year. And that's what it normally is, right? In most cases, there are limitations based on the dividends, and most companies are non-participating. So in other words, the rate is typically the same, and there's a limitation on that rate every year. treasury stock. And Mark, this is probably what you were thinking about earlier. Because remember we were talking about the different types of stock, and you were like, oh, there's one that's given to the investors. It's probably treasury stock is what we were talking about, from what I remember. So treasury stock happens two different ways. One, the original investors. Two, treasury stock occurs when the company repurchases stock. So let's say you own a share of Starbucks stock, okay? And Starbucks comes to you, and your stock's worth $10. Starbucks comes to you and says, hey, you know what? We'd like to buy that share of stock back from you, and we'll give you $12 per share. So that's a $2 premium, right, that they'll give you on each share of stock that you have. When the company repurchases its own stock, it becomes this thing called treasury stock. And companies do that in order to raise the value of the share price of each stock. That's typically why they do it. Why do they do it? Maintain strong market value. That's the primary reason. Other reasons: to give stock to other employees as a form of compensation, avoid hostile takeovers, use shares to buy other companies. There's a lot of reasons why companies engage in treasury stock programs. But a treasury stock program is basically when a company comes in, repurchases their stock from you, the stockholder. A couple of journal entries we make when that happens: we debit treasury stock, common stock, credit cash. In this example, $11.50 per share. Looks like it was at par value, at the par or the market price. When the company sells its treasury stock to other individuals, debit cash, credit account, treasury stock. This is what most companies do: is that they'll actually sell the treasury stock above cost, and when that happens, they get additional. They're selling it at a premium, right? So when you sell something at a premium, of course, you're going to get a little bit more. So it'd be in excess, right? So debit cash, credit treasury stock for the value, and we credit paid in capital treasury stock. Paid in capital in excess. Sometimes they'll sell it below cost. I don't know why you would sell anything below cost, but sometimes they do it to attract new investors. So they resell their treasury stock below cost, or let's say the price per share dropped on the market. Debit cash, increase your cash. Debit paid in capital, treasury stock, because you're selling the treasury stock, yeah. Debit retained earnings, credit treasury stock. Statement of retained earnings. The statement of retained earnings is the fourth financial statement. Well, technically it's the second one. But so you have your income statement, statement of retained earnings, balance sheet, statement of cash flows. Those are your four. Those are the four primary financial statements in the business. The statement of retained earnings shows us the cumulative amount of net income minus any losses, minus any dividends to get us retained earnings. That's what retained earnings is. It's retained in the business. Net income minus any loss minus dividends paid equals retained earnings. Retained earnings is what is retained in the business. It's what's kept in the business. And retained earnings are used for reinvesting in the business. Most cases, there's restrictions on the use of retained earnings, and there's contractual agreements with the use of retained earnings. It's all about that regulation, right? Prior period adjustments with retained earnings. These are the adjusting journal entries that we make in the event of any errors from previous year's financial statements on retained earnings. We use retained earnings kind of like an adjustment account. It's kind of like almost, well, I don't want to use the word catch-all, but kind of is. We use retained earnings account for various adjustments for any errors that may have been made in the past. And that's through the audit process. You don't have to worry about that in this course, but it's good to know. Statement of stockholders' equity. Technically, this is the 5th financial statement, but it's not really used that much in business. Statement of stockholders' equity represents the changes in stockholders' equity over the course of the year. We've got beginning balance plus net income minus issuance of common stock minus any purchases minus any cash dividends, getting us to our ending balance, which basically shows the changes over the year. It's a nice little report, I guess, if you're interested in looking at changes in common stock. Oh, ratios. You guys love ratios, don't you? I thought I remember you saying that. Maybe not. Okay, basic earnings power. Basic earnings per share. Basic earnings per share is nice because it tells us the company's ability to pay a dividend. That's what it tells us. It's the company's ability to pay a dividend. That's basic earnings per share. We take net income, found on the income statement, minus preferred dividends, found on the balance sheet under equity, divided by the weighted average of common shares outstanding. Yeah, not everyone likes the ratios. I mean, I do. Well, to some degree. Some ratios I don't like. Some ratios I don't find as useful. Here's another ratio. I'm sure you'll love it. It's called the price-earnings ratio. This tells us about the expectation of future company growth in terms of earnings, dividends, and opportunities. I take this one at face value. It's probably not the most useful one, but it's nice to know. We take the market value, which is the price per share at the time, divided by the earnings per share. Don't worry, I'm not going to have you guys do something like that. Maybe in the homework a little bit, but not on the exam. Dividend yield. The dividend yield is the amount of cash dividends distributed relative to the stock price. We take the annual cash dividends per share divided by the market value per share. Don't worry too much about it. We're not going to dive too deep into this. This isn't a finance class. This is accounting. That's more finance. Book value per common share. This one's useful because it shows the applicability of common shares on a per share basis. We take the shareholders' equity to common shares divided by the number of common shares outstanding. That, my friends, is a conclusion of our corporate accounting. Any questions, corporate accounting, before we move into a discussion on long-term liabilities? You all good? Okay, I'm going to stop this recording. We'll start the next one.